Hey guys, it's Sasha. So this morning we found out that UK GDP grew by 0.7% in Q1. This was apparently more than expected, and the media and the UK government are all wildly celebrating. Here's Rachel Reeves giving herself a massive pat on the back. Today, growth figures show the strength and potential of the UK economy. Against a backdrop of global uncertainty, we're making the right choices in the national interest. But there is more to do. We will go further and faster to make working people better off. And you see, I was going through the data, and the thing is, I really want the UK economy to do great. The problem is, I am a mathematician. I studied maths, I have worked in finance almost my whole career, and the one thing that really gets to me, the one thing I really dislike is when you're looking at data, like a volume of data, and different bits of the data just don't stack up. When I see data in some reports that completely contradicts data in other reports, when two different charts in the same presentation show data that doesn't work together, where they don't line up, that kind of thing. When looking at different data points, you just know that one of them must be incorrect because they contradict each other. It's like knowing that you bought half as much food in the shop this week compared to last week. Also knowing that the average price of the things that you bought was lower because you opted for cheaper items, but then seeing the credit card charged more money than it was last week. It just doesn't add up, right? Those three data points do not add up. So we've had an extremely bad UK jobs report 2 days ago where data for Q4 and Q1 was revised downwards. The UK is losing payrolled jobs at the moment. The number of jobs in the UK has been falling for the last 6 months at the fastest rate since the financial crash, if you exclude the one of 2020 plunge. At the same time, the UK manufacturing PMI report is on 45.4. It's below 50. It has been below 50. That means manufacturing is contracting and has been contracting since October. UK business confidence hit a record low in Q1 and has been strongly negative for the last 4 quarters, including the current one that we're in right now. According to Standard & Poor's, the UK composite PMI has also gone negative. April data signaled a sharp downturn in business activity expectations for the year ahead. The degree of optimism reported by survey respondents was the lowest since October 2022. The number of job vacancies in the UK is collapsing at a rate which is normally only seen in the run into a major recession. So we have all of this data, way more than this, and we have anecdotal data that we hear from business owners. I personally hear it all the time, who are sounding the panic alarms. But then we get the GDP report, which says that the economy is booming. It grew 0.7% in the quarter, which is a run rate of about 3% a year, which is actually very good, right? If that is what the UK economy is going to do, that is fantastic. But the obvious question is, how is the economy in the UK growing when every single data point is telling you the exact opposite? It's telling you that the UK economy is in deep doo-doo. Well, I went and looked at the numbers, and I am going to show you that the UK economy actually contracted in Q1 in real terms, in the real world. So first up, what is GDP? So that we're clear, GDP is the gross domestic product, the sum of all the economic output of a country. And there are generally 3 different ways in which you can measure GDP, which should give you the same answer, regardless of which way you use it. The first method is measuring the output. So you go and add up the value of all the goods and services produced in the country in Q1, and then compare it to the value of the goods and services in the previous quarter, and you work out the difference. That's like the raw definition of GDP. Then there's the expenditure approach, measuring the same thing in a different way. So instead of measuring the production of stuff, you measure the spending by people buying the stuff that was produced. And largely speaking, there are like 5 components that add up in this method of calculation. Depending on how you group it, there's the general consumption, then there's business investment, which is businesses spending money on stuff like new factories, new factory equipment, etc. Then there's the net change in inventories. Then there's government spending, so the sum of all the money that the government is spending in the economy. And then you need to add the net export, so stuff that is not bought inside the country, but bought outside the country, having been produced within the country. And then there is the third method of working out GDP, which is the income approach. So instead of measuring the stuff being produced or the stuff being purchased, you measure the flow of money instead. It's like the cash flow method of calculating it, if you like. So you add up all the salaries paid to people. Then on top of the salaries, you add up all the profits that the businesses make on top of paying the money out to employees. And then you add up the taxes paid by businesses and people. And that last method is a little bit more difficult because it is very easy in that one to double count money movements when there is a very long supply chain of intermediaries and intermediate products. And if you look at that last method, the majority of the increase in GDP in the last quarter is just coming from, you guessed it, salary increases and increases in government taxes. So there is that. But let's dive a bit deeper and look at what is actually driving GDP growth, or whether there is any growth at all. I promise you will like this one. So here is the detailed breakdown from the Office of National Statistics. And here is the overall number. You can see that in Q1, it was £738 billion. And in Q4, it was £727 billion. That is an increase of around 11.4 billion, which is 1.6%. But that's before adjusting for inflation. Whenever you see GDP numbers announced, they are after adjusting for inflation. So what the government does is it takes the 1.6% increase and it strips out inflation. And that's what happens in the next two columns. And then you get this gross domestic product at market prices chained volume measure. This one comes in at 646.8 billion in Q1, and it was 642 billion in the previous quarter. And if you work it out, that's a plus 0.7% difference. This is the difference that everyone is reporting today. This is the GDP increase that we're all seeing in the media. And if you work out, if you subtract the two numbers, the difference is 4.5 billion pounds. That is how much GDP has gone up using this calculation after the inflation adjustment kicks in. That's the chained volume measure, where 2022 is the 100%, whatever. So let's go and look at exactly where that 4.5 billion is actually coming from. By the way, if you're wondering why you can't see me as well in some other videos, I have a furry friend over here sleeping, so I had to turn down some of my lighting. So there you go. But let's look at the latest UK trade bulletin. You will see this line here that says export of goods to the United States increased for the fourth consecutive month. There was a £2.4 billion rise in Q1 2025, while imports of goods from the United States rose by 1.3 billion. So ahead of the tariffs hitting in the US, there was a 2.4 billion extra load of exports to the United States by companies looking to beat the tariffs. This is the same thing as what's happened with many other countries as well. And that's what caused US GDP to look particularly bad in Q1, because they had such a surge of imports in Q1 ahead of the tariffs coming in. This is the raw nominal value. So that's before the inflation adjustment. So out of that 11.4 billion nominal increase in GDP, 2.4 billion came from shipping a bit more stuff to the US ahead of the tariffs kicking in. So about 21% of that Q1 GDP growth in the UK came from that. Now, let's look at table C2, expenditure, in the same data set. And at the top it says that these are chained volume measures. So these ones are after adjusting for inflation. You can see at the end of this table, we have the same 646.8 billion pounds in GDP. And it's up 4.5 billion from the previous quarter. So let's look at the last two rows to try to figure out where is that increase coming from. Well, households' final consumption has only moved very slightly by 700 million pounds, so the difference is not really coming from there. Non-profits have not moved. General government consumption is actually slightly down, so that's definitely not where the GDP growth is coming from either. And then look, gross fixed capital formation, 118.5 billion in the most recent quarter, and it was 115.1 billion in the previous quarter. So that's plus 3.4 billion. And in the next column it says, of which business investment gross capital formation. And look at the last two numbers, 67.6 billion minus 63.8 billion, that gives you 3.7 billion pounds. So that's almost all of the GDP growth in the last quarter that is coming from this one line called business investment. It's not coming from people buying more stuff. It's not coming from government buying more stuff. It's not coming from businesses buying more stuff. It's coming from this one line called business investment. So if you add this line and the 2.4 billion extra of US exports, the sum of those two things is more than the whole of the GDP growth in the quarter. So without those two things, GDP would be negative if those two things were flat. So of course, I went and found the data for the gross fixed capital formation in more detail to see exactly what is happening in there. Why is it going up? And you can see the same 67.6 billion pounds at the bottom of this first line, which is the total business investment. And if you notice at the top of the sheet, it says chained volume measure seasonally adjusted. And if you go to table G4, this is exactly the same data, but it's not seasonally adjusted. So this is the real data. This is the real pounds before the statisticians get their fingers in the data to make it more accurate. And in the first table, they go and change the numbers to try and account for the differences in seasonality. The thing is, applying a very big adjustment to business investment based on seasonality is, in my opinion, a bit of a statistics clown show. Clearly, in Q1 of this year, with the specifics of the economy as it is, where it is, with all the other factors considered, with the extra taxes, with businesses making priorities on where capital should be deployed, they are making specific choices which may be different to a different year. And to me, making these seasonal adjustments to numbers like these just doesn't actually really make sense. I get it. If you're talking about crops or other produce like that, or things that are highly seasonal, like, I don't know, vacations and travel, those seasonal adjustments kind of make a lot of sense. And it is also true that investment by businesses in Q1 is usually, over long periods of time, on average, a bit lower than investment in Q4 of the previous year. That does tend to be the case because in general, spending on capital investments does tend to be higher at the end of the year than it is at the start of the year. But let's take a big step back here, because investment by businesses fell in Q1 of this year by £1.5 billion. The same thing happened last year. It also fell in Q1, but the previous year it went the other way around. Q1 was actually higher than Q4. It oscillates quite a lot. There's quite big differences. It's not very consistent. But this year, business investment in Q1 fell in real numbers. But when you make the statistical adjustment, to make the numbers look good, seasonality, the 64.8 billion of investment magically becomes 67.6 billion pounds of investment. And suddenly, instead of investment dropping, which is what actually happened, it looks like investment jumped up almost £4 billion. And this is literally the only thing responsible for almost all of the GDP growth in the quarter. This statistical adjustment here. So here is what happened. Business investment in the UK in Q1 dropped by £1.5 billion. The rest of GDP growth in the UK, excluding the one-off bump from US exports to beat the tariffs, was negative. So GDP in the UK contracted in Q1 without that one-off item of US exports heading to the US ahead of schedule to beat the tariffs. But then you go and take the £1.5 billion drop in business investment and you apply a magic seasonal adjustment. And you get this wonderful £5.3 billion swing in the difference between Q4 and Q1 upwards. You get this huge increase. That is statistics for you. For a completely unknown reason, the revision upwards was way higher than in any previous years. Just happened that way, by complete fluke. This, of course, had absolutely nothing to do with politics, nothing to do with influence from the government, from the UK government needing to magic some good GDP numbers out of a hat to, get some good publicity, and that completely by accident made the GDP growth in Q1 plus 0.7% instead of being negative, which, of course, beat expectations. I am sorry to be that guy who spoils the magic trick by explaining exactly how it was done, but there you go. Pop open the champagne, get the caviar. Let's celebrate that the UK economy is booming, right? Along with all the media. Remember, if you want to join my investor playbook course, I'm running a 10% discount this week only. That's it. It's going to be ending at the end of Sunday. Use the code MAYDAY to get your 10% off. Link is in the description and pinned comment. I do live sessions with my course members every Thursday afternoon on top of all of the course content. So if you want to get the discount, make sure you get it before the end of Sunday when that coupon will expire. Thank you so much for watching, and I'll see you later.